Now let's talk about the concept of crowding out in fiscal policy. We already learned that if there's an increase in spending and a decrease in taxes to engage in expansionary fiscal policy and cure a recession, the government's going to run a budget deficit. The problem is, when the government runs a budget deficit, they enter the loanable funds market and soak up the supply of loanable funds that would ordinarily be going to firms and households. Because there are less funds for firms and households, that means that the price of loanable funds for firms and households go up. Interest rates increase. And those higher interest rates cause households to consume less, firms to invest less, and actually affect net exports as well. So the government is trying with its fiscal policy to increase spending by raising government spending and lowering taxes. But at the same time, they're driving up interest rates and decreasing spending in the economy. That's crowding out. Let's look at it in a graph. Let's say that we start at point A. This is a short-run equilibrium. We're at 17.2 trillion, but of course we want to be at 17.4 potential. The government recognizes this is a recession, so they begin spending more and taxing less. That means they're running a budget deficit. That moves aggregate demand to the right. Now, optimally, aggregate demand would shift all the way over here to 82, creating a new short-run equilibrium at point B, which aligns with potential. Unfortunately, if there is crowding out, the aggregate demand curve is not going to make it all the way to create point B. Let's say that because of crowding out, the aggregate demand curve goes from 81 to 82. And that puts us at point C. In other words, the fiscal policy got us closer to potential, but it didn't get us there. Because the government, when running the deficits, drove up interest rates and caused households, firms, and the foreign sector to buy less American stuff. When it comes to consumption and investment, it's pretty straightforward. As interest rates go up, it becomes more expensive to borrow money. Cars become more expensive because the monthly payments are higher. Homes become more expensive because the monthly payments are higher. Your credit card bills go up because the monthly payments are higher. So people spend less. Same thing with investment. Firms find higher interest rates to make it more expensive to get equipment, capital. The net exports that result from higher interest rates are a little bit more complicated. Higher interest rates actually attract capital from other countries. We learned this in a previous section. Higher interest rates means that savers all over the world will want to put their savings in American banks and in American bonds. And so there'll be an inflow of capital from other countries. Of course, to open those American savings accounts or to buy American bonds, these foreigners are going to have to buy dollars. And that's going to cause an appreciation of the dollar. But when the dollar appreciates, that makes our goods more expensive for foreigners. So that decreases net exports. So we get the trifecta. Higher interest rates drive lower consumption and investment because it's more expensive for Americans to borrow. But higher interest rates also drive a decline in net exports because ultimately our goods become more expensive to foreigners. The result is aggregate demand increases to the right but snaps back as consumption, investment, and net exports decrease. It's an uphill battle when there's crowding out for government. It's not as simple as just run deficits to stimulate us out of a recession. Governments may implement the policy and find the results to be less than expected. Let's wrap this section with a little bit about supply side economics. Understand that when we study monetary policy and fiscal policy, we're studying demand side economics. In both cases, the government was attempting to either increase aggregate demand if there's a recession or decrease aggregate demand if there was a lot of inflation. But it's demand focused. There is another way to have the government involve itself in the economy, and this comes from the supply siders. There was a policy shift after the 1980s that led to more supply side focus, and that shift continued all the way up until really the Great Recession of 2008. These economists favored decreasing taxes and regulation. Their goal was not the typical fiscal policy of demand-side economics, where, recall, we lowered taxes in order to get people to spend more. That's not why these supply-siders want to lower taxes. They want to lower taxes because they believe that if you lower taxes, you'll actually get people more incentivized to work, you'll get people incentivized to invest more, and you'll incentivize people to innovate. This will create a shift, not in aggregate demand, but in long-run aggregate supply. In essence, they believe that lowering taxes and regulation will create a fertile environment for economic growth. Now, supply-siders see regulation in particular as concerning because regulation to a business is a cost. If a business has to install special equipment or provide special benefits to employees or any other type of regulation, it sees the cost of production as higher, and therefore it's not going to produce as much. By lowering regulation, firms are incentivized to produce more stuff. To understand this concept of supply-side economics, think about what's called the tax wedge. The tax wedge is the difference between pre-tax and post-tax returns. For example, when you go to work, you base your work decision on the post-tax wedge. If you look at your pay stub when you go to work, let's say you make $1,000 on your paycheck. Well, if you look, that's going to be the net post-tax wage. It's very likely that your employer paid you more than that. They may have paid you $1,300, let's say, but you only see $1,000. And that means that you base your work decision on the $1,000, even though the employer paid you $1,300. That tax wedge, that $300, goes to the government. The problem is you're less incentivized to work and participate in the labor force if you see less of what your employer is paying you. If your employer is paying you $1,300 and you're seeing $1,000, the incentive to work is not as great as if your employer is paying you $1,300 and you're seeing $1,100 or $1,200 or even $1,300. By lowering the tax wedge, that is by reducing taxes, the belief is that individuals would work more. They'd work more hours, and they would participate more in the labor force, and that would stimulate economic growth. The same idea is for firms. Firms base their production decisions on post-tax profits. Maybe a firm sees $1,300 in profits, but then after taxes, it only gets to keep $1,000. Well, that's a tax wedge of $300. If you can lower taxes, maybe that firm gets to keep $1,100 or $1,200 or even the full $1,300 in profits that it made. By lowering taxes, you incentivize more people to go into business and existing businesses to produce more and expand, again, stimulating long-run economic growth. And then another example of this is investors. Investors base their decisions on post-tax return. Imagine you buy stock in a company, and let's say you make $1,300. But after paying your taxes, you only get to keep $1,000. Well, that's again a $300 tax wedge. If we can get that tax wedge down, then you're more likely to buy stock. You're more likely to invest. And that provides more funds for businesses to grow. and it provides more capital equipment for workers to be productive. All of these things feed on each other, all by lowering taxes. The Great Recession of 2007 and 2009 caused a resurgence of demand-side policies. But there's no question that when you look at these supply-side policies that were put into effect in the 80s, in fact, during the 1980s, the top federal marginal income tax fell from 70% to 33%. They had a strong impact on the economy. In fact, the period after the 80s up until the Great Recession is known as the Great Moderation, because it was a period of minimal recession and high levels of economic growth. So these are important, and there's some tax rates that seem to be particularly useful in incentivizing people to work, invest, and come up with new innovations. The individual income tax rate, the corporate tax rate, and then the tax on dividends and capital gains. All of these were reduced during the 80s, stimulating long-run economic growth. This guy here, Arthur Laffer, was the leading economist for the Reagan administration back in the 80s. And he was trying to make the point with what's called the Laffer curve here, that the government could actually lower taxes and not only stimulate the economy, but also get more revenue than it would at higher tax rates. Now that seems counterintuitive. How could you actually lower taxes and the government ends up with more revenue? Well, he drew this curve to illustrate his point. It's on the vertical axis, the tax rate from 0 up to 100. On the horizontal axis is the tax revenue. So what he said is that if you have really high taxes, you actually have low tax revenue. For example, if you tax someone 100%, no one works. So tax revenue is 0. But if you tax them 0, everyone works, but there's no revenue. As you move the tax rate up from 0, you're going to see initially tax revenue increase, because even though tax rates are low, it's not compromising people's willingness to produce. The tax wedge is minimal. Then you're going to reach some tax rate, some point where if you continue to raise taxes, revenues are going to go down. Because as you move past this turning point here, you're going to find that people work less, that the higher taxes are so cumbersome to people that they're actually choosing no longer to work or no longer to start a business or innovate. And his point was that we had really high tax rates in the 70s. And so if we lowered them, yes, we would be collecting less taxes on each dollar earned, but we would actually incentivize people to earn more dollars. So as we lowered taxes, tax revenue would go up. And that's exactly what happened. So we had a situation during the 80s where we were able to lower taxes and regulation, stimulate economic growth, and actually generate more revenue for the government. Last point. When you stimulate long-run economic growth, the results are not only an increase in sustainable GDP, but also deflation. We go from A to B to C. You not only see more productivity, which means people's incomes are going up in real terms, but they're also seeing the prices of things that they buy go down. True economic growth is revealed to people through higher incomes and lower prices. All right, now you have hopefully a good sense of the business cycle, fiscal policy, monetary policy, and lastly, the incentive to use supply-side economics to grow the economy and get people to be as productive as possible so we can get the highest incomes and the most access to goods and services in the economy.